welcome to the special show called Pachu Trades. As we go into the much anticipated event tomorrow, we have with us two special guests, Gautam Dugar, Head of Research, Institutional Equities of Motilal Oswal, joining us, and Rahul Arora, Head of Institutional Equities at Nirmal Bang, talking to us about what the markets are expecting and how much of this is already in the price. Thank you very much for taking out the time to talk to us. To begin with, there's so much I know happening. Budget is just one of those many events that the markets are currently working with and grappling with. But let's start with that, right? With a weaker than expected mandate for the BJP, there is some sort of nervousness in some parts of the market which do believe that the budget could be a lot more populist than the equity markets would have liked. Do you agree? Do you feel that nervousness is justified at this stage?
Good afternoon, Samina. Thank you for having me on the show. So I think that's a reasonable assumption to make. I think if you look at countrywide, when you look at states like Telangana, Jharkhand, Maharashtra, I think some populist measures have already started on the ground, whether it's with respect to farm loan waivers, increasing PM Kisan, and so on and so forth. But it would not be an unreasonable expectation to expect that the tilt would be more towards populism than capex in this budget. That being said, I don't think they're going to take the foot off the pedal as far as capital expenditure is concerned, because I think if you look at the last 10 years of the current establishment, capex growth in the first 5 years on a CAGR basis was about 15-16%. That dropped down to about 8% for the remaining 5 years, that is FY19 to 24. Obviously, you had 2 years of COVID in that, where not too much capex happened, but still, an 8% CAGR is not something that they would want to go down from. So I don't think they'll necessarily take the foot off the pedal, but yeah, it would not be unreasonable to expect, some kind of a populist tilt. And by populist, I don't necessarily mean doleouts. Even for the bottom of the pyramid income levels, the tax exemption that people are talking about, if that's increased by 1 lakh or 2 lakhs, and that puts another 10-15,000 in the hands of people to consume, that's another way of looking at populism. So I think all things considered, we're looking, I think the headline number that everyone is obsessed with in every budget is the fiscal deficit. And I think that will probably be retained at about 5.1%. I can't see them changing that. But like I said, it would definitely be a 60-40 more tilted towards what you would call consumption populism rather than capex.
Consumption populism, which may not be too bad given the fact that rural economy is the one that's struggling, and we saw that at the election outcome as well. But just before we go into that, Gautam Dugar of Motilal Oswal as well joins in. Gautam, hi, thanks for joining in. Gautam, before we talk about the budget, let's talk about how the mood has been on the street. How optimistic, how buoyant, how confident are market participants feeling just ahead of budget 2024?
Hi, good afternoon. Thanks for having me. I think, the mood is best reflected in the way markets have behaved in the calendar year, and also the way flows have been. In the first 6 months, you've seen close to $28.5 billion coming in from domestic institutional investors, which is, by the way, 30% more than what you've seen in the full calendar year 2023. So market obviously has been on a tear. If you look at the trailing 12-month returns of mid-cap, small-cap indices, today you're talking about a market where mid-cap index is trading at a 60% premium to Nifty. Small-cap index is also now trading at a premium to Nifty. So clearly the mood is very buoyant, and I would even say euphoric in some pockets. Clearly some pockets where earnings have not followed through, valuations have gone for a toss, right? Insofar as large cap is concerned, clearly things are far more sober, I would say, vis-a-vis what we are seeing in mid and small cap pockets. Nifty is still trading somewhere about 20 and a half times, which is broadly in line with the 10-year average. Of course, if you look at the numbers ex financials, valuations look very different, but so be it. Financials is 1/3 of the Nifty weight, so you can't exclude that. There will always be some pockets which are undervalued, some which are overvalued, but broadly, large cap looks okay to me. It's mid cap and small cap where things have gone a bit awry. As far as budget is concerned, I think we overhyped this event too much. If you see the last 7-8 years, you would notice that budget gets discussed 24 or max 48 hours. After that, market forgets the budget and goes back to fundamentals. I don't think why this time it should be any different. Yes, there are some expectations because this is the first budget of the Modi 3.0 government, and clearly the setback that they've received in the elections. So there are some tinkerings that can happen in the overall budget numbers. But broadly, I think the policy of fiscal conservatism and overarching focus on capex should continue with a little bit of tilt or some allocation given to bottom of the pyramid or middle class or tax giveaways, so have you, because you have 1.5 lakh crore of extra firepower available thanks to the RBI dividend. So I hope the government utilizes it sensibly and encourages consumption at the bottom, because that is one area which has been severely lagging in the last 2.5 years if you look at the corporate results.
Rahul, I want to try and understand from you as well, what are your thoughts on the broader markets? I remember a few months ago, it was CLSA that put out a whole list of stocks calling them Modi stocks. There were a bunch of them, and most of these stocks haven't moved very much since the election verdict on the 4th of June. As we go into the budget this time, the bullish sentiment index indicates 92% people are optimistic in that sense about the budget, which makes me believe that with very stretched valuations, extreme optimism around the markets, we may be looking a lot more vulnerable now than we ever have. Would you agree?
So I think, Samina, the one thing that the sell side has got perpetually wrong for the last 10, 12 years that we have seen, and I think everyone collectively needs to take responsibility for it, ourselves and our brokerage included, is we overestimate earnings at the start of every year, and we have to, at the end of the year, downgrade those earnings. And I think this has been a consistent phenomena for years, and if you look at the Bloomberg estimates, they will be no different. You were talking about valuations. I think they have been, when you look at the mid and small caps, they have gone beyond reasonable expectations. I don't even think there is a conversation to be had about whether they're reasonable anymore. When we talk to institutional investors and some of the larger ones, we're actually discussing sell ideas, believe it or not. They actually want to know what to exit rather than what to buy. And I think, I was just looking at, we research about 180, 190 odd stocks, and I was looking at the last 4 quarters data. On average, we have downgraded about 60, 65% every, on a trailing basis every quarter. So you're not in an earnings upgrade cycle by any stretch on an aggregate basis. Will stocks be cheap? Of course, there will be stocks that are cheap at a 24,000 Nifty. There'll be stocks that are expensive at an 8,000 Nifty. But I think at an aggregate level, there is just way too much. I think it's beyond price to perfection. Just take a look at what's happening with Wipro today. There is no room for error. If you slip slightly, the market's going to punish you. There seemed to be a semblance of that happening with defense stocks last week. I think we're probably one of the first brokers on the street to actually downgrade the entire sector to a sell, because it had reached levels that we did not understand, and we were happy to put that. But I think the way the market is behaving, and this has nothing to do with the budget, and I think the point has been made consistently, Samina, and you probably, running your shows have got bored of hearing of this, is that it is a liquidity driven rally. I mean, it is way ahead of fundamentals. Any fund manager, that you speak to will tell you that, for companies that are 20-25% return on equity or capital employed, stocks are trading at 55, 60 Ps. That kind of makes no sense. So I would personally love it if you had a 15-20% correction in the market. I think it would restore some sanity. But I think the probability of that, Samina, I've pretty much thrown in the towel. I've got my call on the market consistently wrong. We're up 18% from the 4th of June lows, and nothing has changed in India barring flows. So, if the flows sustain, then, who's to say where we go? But, given where the overall fundamentals are, especially with respect to earnings, I think we're way, way ahead of where we should be.
Yeah, I think it's uncharted territories, Rahul, and I think people who've been calling it a top, stay on the sidelines, making cash calls all the way back in October, are probably going to be disappointed as we look at things right now. But the fact remains, 20% of Indian household spending is now coming into financial assets, and this money is sticky. So I think that's what we need to be mindful of as well. But let's move on to a few other aspects before we go into earnings and the fact that the markets have borrowed returns from the future. Gautam, one thing that I want to highlight with you and get your perspective on is the monster that rears its head out before every budget, and that's the fear of changes to our capital gains tax regime. The same worries seem to have resurfaced in many quarters, and some believe that this could be almost a given this time around. Do you think Budget 2024 will see any tinkering or changes to the existing capital gains tax regime? As it stands, the current regime is, or the different rates, the different holding periods based on different asset classes. What is your expectation here?
So I don't expect any change. See, it's an annual ritual where we, prior to budget, every year discuss about the bogey of inheritance tax, wealth tax, changes in long-term capital gains tax. So this year is no different, and everyone goes wrong after the budget is over. So I think government is making good collections on short-term capital gains tax, on STT. So capital markets are doing well. In general, the wealth creation has been pretty phenomenal for the last 10 years also, because Nifty itself has compounded at 16% for last 10 years, your mid cap at 20% and small cap at 24%. I'm talking about a 10-year data. Economy is doing well. Macro, micro are in perfect harmony, I would say. So it will be very, I would say, imprudent for a government to now tinker with something which is doing well. And it's not as if that they're going to make a huge collection, even if they change the duration or they change the tax rates much. So at least I don't expect too much sort of tinkering over there. And hopefully this will be forgotten after 48 hours, because tomorrow the entire media investment community is going to get busy discussing this thing. But if you go by the past experience of last 5-6 years, you can check the news flow before the budget. Every time there is a discussion on inheritance, whether inheritance tax is coming or not, whether there's going to be a big change in long-term capital gains tax or not. I think the way the political results, the mandate has been of 4th of June, I don't think government will take a step where they start antagonizing more middle class people now. Because if you look at the way equity cult has evolved, in the last 4 years, the demat account itself has gone from 3.5 crore to 16 crore. So equity investment is no longer the reserve of few cities or few pockets. It's spreading across the geography. So I don't think government is going to try and tinker that for few extra 100 crores or 1,000 crores of money. They can easily get that from some other line items here and there.
Right. Rahul, very quickly, a very unconventional view came about last week, where Chris Wood of Jefferies said that India does not need a capital gains tax regime. And he cited the example of jurisdictions like Hong Kong, which have actually benefited. Do you want to respond to that? Do you feel like there could be some streamlining, or that very, extremist view coming from Chris Wood's actually holds some value?
I think even if it's to be done, Samina, I don't think this is the right time to do it. And partly because I think, the kind of investors that have come into the market post-COVID, they haven't really seen a bear market. They haven't tested waters. I think, a lot of these people that have come in, in the age group of 18 to 25, 30, it's too early to set them back with these kind of regulations, is my sense. Would it probably happen over a longer period of time? Yeah, but I think it could potentially derail a little bit of the equity culture that you're looking to establish. I mean, if you look at capital markets today, they've become the default funding option. I think, you have flows moving away from fixed deposits into mutual funds. You have promoters looking to tap capital markets to raise money. So I think at this point in time, when it's become the go-to weapon, so to speak, for various aspects, I don't think this is the right time to do it. I mean, we can debate on whether there are merits or demerits of doing it, and I'm sure if the government decides to do it, they would see merit in it. But I think at this point in time, when you're just looking at the financialization of savings happening into equity markets, despite these ridiculous valuations, you're seeing 30, 40,000 crores of flows that are coming in. I don't think, the government would do anything to derail that at this point in time. So look, personal income tax collections are extremely buoyant. I think, we must be one of the very few countries in the world where our growth in personal income tax is more than the, growth in the corporate tax rate. And that's one of the reasons why people keep talking about giving tax breaks to the people who actually fund the economy, which is basically people like you and me. But, that becomes counterproductive from the government standpoint at many levels. So I don't think at this point they're going to tinker too much with it. I think it'll probably be counterproductive in their larger scheme of things to be doing anything to capital gains tax at this point.
Now let's get down to actionables now, and what investors should be doing. I know most portfolios haven't done half as well as the index itself, and there is still a feeling of, FOMO in that sense. What do you recommend investors should do? Should they take profits off the table? reinvested in a staggered manner? Would you recommend them keeping some dry powder for a potential correction and a better opportunity to buy? If yes, what sort of levels would those be? Because from where we stand right now, we definitely have borrowed significant returns from the future already.
So I think, Samina, wherever your stocks are trading at north of 50, 55 times on a 1 year forward, I think that's the answer is very evident. You can certainly sell. I think where you can move in is where valuations are still reasonable. I still think in the BFSI sector as a whole, valuations are not demanding. I mean, the elephant in the room, HDFC Bank, currently trades at about 2.2 times 1 year forward price to book. They've grown their NIS by 26%, their profits by 35%. I mean, I don't know what else the street wants from this company, but I think, names like this, I think you have value picks even in the insurance sector. I think there is some value even on the gold finance side. Something like a Manappuram Finance, where for a 16, 18% return on equity trading at 1 times price to book. So I think definitely BFSI is one place where you could look at. I think technically, Samina, the market was underweight on IT services. And I think that's why, barring Wipro, I think the other IT results that you have seen have been very easily bought into. Add to that the potential, noise that has been increasing as far as the Trump presidency goes. I mean, a lot of polls are putting him ahead. That could potentially bode well, because I think if you look at, how globally things stack up under Republicans versus Democrats, the overall environment may actually be more conducive towards spending in the United States, particularly because Trump is a capitalist. And given the BFSI exposure that you have for Indian IT companies, I think IT could be an interesting play as well. And go back to where we started this conversation, Samina, if the government does indeed decide to tilt a little bit towards consumption, again, that same technical factor of under ownership is there in consumer staples. So I think there could be potentially some interest moving into names like an ITC, Dabur, etc., if the rural recovery takes place. So I think there are still some pockets. And lastly, maybe cement. I know Ultratech wasn't a great bag, but I think that could potentially, because the first order that the prime minister signed when he came back into office was a housing order, and I think NHAI's road allotments last year were not that good. They'll probably pick up this year. So I think these are 3-4 sectors where valuations are not as demanding today as probably the rest of the market are. So you can certainly take profits in companies where your stocks are trading north of 50, 55 times, and look at entering some of these stocks and sectors.
Okay, so that's BFSI, insurance, consumer staples, cement. Rahul's been kind enough to name a few like HDFC Bank and the likes of a Dabur that one could allocate to an IT as well. Gautam, what about you? What does your portfolio stand currently? Have you recommended to your clients to sit on cash? If yes, how much? And if there is a re-entry point, where would that be and where would that money go into?
So we just published our model portfolio a fortnight back. We made several changes. We had gone overweight on IT, overweight on pharma from being underweight and neutral earlier. We have reduced auto from overweight to underweight now. We continue to be significantly overweight on PSU banks. We find valuations very attractive even now. In private banks, we are slightly underweight because of our underweight stance on HDFC Bank since 2 years now. So that stance continues. But within the private sector banks, we are overweight on ICICI and Axis. Then we are overweight on industrials and real estate, which played out beautifully. But now we have to reassess given where relative risk reward lies. And as far as underweight is concerned, we are still underweight on energy. We are underweight on metals and also on cement. So our entire capex and industrials weight is lying in capital goods and minor weight in defense, and of course, big overweight on real estate. So net-net, we are trying to move the portfolio slightly more defensive, which is why you have seen a change in allocation towards IT and pharma. And then in consumption, we have a huge weight. We have about 20% weight in consumption, but within that, discretionary has been our preferred choice. So out of that 20% weight, staples is only 4% and 15% is consumer discretionary, where we have names belonging to jewelry, hotel, QSR, food delivery, then cables and wires, all sorts of things. So from a slightly longer term perspective, we've been more positive on discretionary versus staples. But staples opportunistically one can play for this budget event. I don't expect any significant pickup in volume growth there. Maybe something which is growing at 2-3% volume can grow at 4-5, but it won't change the trajectory of earnings growth beyond a point.
Well, thank you very much, Rahul and Gautam, for joining us today on this edition of Budget Trades, just ahead of the big event tomorrow. While you said, or both of you said, that this event is a 24-hour event and markets are so much more beyond that, but significant because it gives us an opportunity to talk to guests like you and build perspective for our viewers. But on that note, thanks for watching. There's a lot more programming on the other side, so keep it with the channel.